Hey everyone, welcome back to the channel. Today we're diving deep into a company that's been turning heads in the fintech world, Sofi Technologies, ticker symbol Sofi. Whether you're a retail investor keeping an eye on innovation, or just someone interested in the evolution of banking and finance, this video is for you. We're going to look at Sofi's business model, how it makes money, where it stands today, what's driving the stock, what risks you should be aware of, and where this company could go next. Let's jump right in. Sofi, short for social finance, started as a company focused on refinancing student loans. But it has since evolved into something much bigger. Today, Sofi is building a comprehensive digital financial ecosystem, with banking, lending, investing, and more, all under one roof. The company's mission is pretty clear: help people get their money right. And to do that, they've created a platform that combines convenience, personalization, and a sleek user experience, aiming to disrupt traditional banking. So what exactly does Sofi offer? First, let's break down their three primary business segments: lending, technology platform, and financial services. We'll start with lending. This is still Sofi's largest source of revenue. The company provides personal loans, student loan refinancing, home loans, and in some cases, credit card lending. Personal loans in particular have been a major growth area, helping consumers consolidate high-interest credit card debt and access fixed-rate options at better terms. One of Sofi's big advantages in lending is its ability to originate loans digitally, at scale, with strong underwriting and automation. They use data to evaluate risk quickly and issue loans without the traditional friction of banks. But here's the big difference today: Sofi is now a bank. After securing a national bank charter through its acquisition of Golden Pacific Bank, Sofi can now hold customer deposits and issue loans directly through its own charter. This allows the company to fund loans with low-cost deposits, instead of relying on third-party funding. That gives Sofi greater control over margins, interest rates, and regulatory flexibility, which can be a long-term game-changer. Next, we have the technology platform. This part of the business is built around Galileo and Technisys, two major acquisitions that form the backbone of Sofi's fintech infrastructure. Galileo is a powerful API-based platform that enables neobanks and financial apps to manage payments, accounts, and cards. It's used by companies like Robinhood, Chime, and others. Technisys, based in Latin America, provides cloud-native digital banking core systems. Together, they allow Sofi not only to serve consumers directly but also to power other fintechs behind the scenes. Sofi essentially becomes a fintech picks and shovels provider, generating recurring revenue from other financial apps that depend on its infrastructure. This diversifies its income and adds a high-margin, scalable business model to the mix. And finally, we have the financial services segment. This includes Sofi Money, cash management, Sofi Invest, stocks, ETFs, crypto, Sofi Credit Card, Sofi Relay, financial tracking tools, and Sofi's new banking products like direct deposit and checking/savings accounts. It's here that Sofi is trying to build a true super app for finance. Instead of juggling 5 different apps for budgeting, investing, and spending, Sofi wants users to do it all in one place. While this segment currently generates lower revenue than lending, it's growing fast, especially as Sofi adds more members and cross-sells products. The goal is to acquire customers through one entry point, then gradually move them into multiple financial services to build loyalty and lifetime value. Now, let's talk about growth. Sofi has been aggressively acquiring customers, both through organic marketing and partnerships. Member growth has been strong, driven by product bundling and strategic advertising. Once users are on board, the company focuses on expanding product per member, which is a key KPI. And with a full suite of services, Sofi isn't just a one-time use platform. It wants to be the primary financial hub for the digital generation. But while the top-line numbers are growing, investors are also watching profitability very closely. Sofi has been investing heavily in infrastructure, compliance, marketing, and R&D. That's led to a series of losses on the income statement. However, the company has been narrowing its adjusted EBITDA losses, moving toward break-even and, eventually, sustained profitability. This transition from a high-growth startup to a profitable fintech bank is what Wall Street is watching most closely. And that's where the story becomes even more interesting. Let's now talk about the stock performance and investor sentiment. SoFi stock has seen massive swings since going public via SPAC. It initially saw excitement from retail investors who believed in the disruptive potential of the platform. Then it pulled back as the market rotated away from high-growth, unprofitable tech. Since then, investor sentiment has been mixed, with bulls believing in the long-term fintech transformation story, and bears raising concerns about competition, regulation, and the path to profitability. One major tailwind for the stock has been rising interest rates. As a bank, SoFi benefits from higher rates on loans, especially if it's funding them with lower-cost deposits. But this can also slow down demand for borrowing, so it's a balancing act. That said, with a full bank charter, SoFi is now better positioned than most neobanks. It can hold deposits, lend against them, and operate like a traditional bank, but with the cost structure and agility of a fintech company. That's a compelling combination. Let's now look at some of the risks and challenges investors should keep in mind. First, competition. The digital banking and fintech space is crowded. SoFi is up against not just legacy banks like JP Morgan and Bank of America, but also fintech startups like Chime, Vero, and even large tech companies getting into finance. The ability to stand out and retain users is key. Second, regulatory uncertainty. As a financial institution and a tech platform, SoFi operates in two highly scrutinized industries. Any changes in banking laws, consumer protection, or digital asset regulations could impact its growth plans. Third, loan performance. As SoFi scales its lending operations, it needs to maintain high-quality underwriting to avoid defaults. Economic slowdowns or high unemployment could stress its loan book, especially in personal lending. Fourth, path to profitability. Investors want to see SoFi hit positive EBITDA and eventually net income to justify long-term valuations. Delays in this path could cause volatility in the stock. Now let's talk about the opportunities. SoFi's biggest strength lies in its ecosystem. It's not just offering products, it's building relationships. When a user starts with a student loan refinance, then adds a checking account, invests through SoFi Invest, and gets a credit card, SoFi increases customer retention and lifetime value. Thanks for watching. If you got value from this breakdown, be sure to give the video a like, subscribe to the channel, and let me know in the comments, are you holding SoFi stock? Do you believe in their long-term vision? Or do you think the risks outweigh the potential? Stay tuned for more updates, and I'll see you in the next video.